Hi friends, this is my fifth video of securities market under investment analysis and portfolio management, and today we will see about buying and selling shares. So let us start. And first we will discuss about procedure for buying shares. Buying shares and debentures involves the following steps. The first step is locating a broker. Typically, shares are bought through a stockbroker who is a licensed member of a recognized stock exchange. So, when you want to buy or sell shares, you should locate a broker. Ask your friend who have experience to recommend some names and meet the suggested brokers personally and make a first hand assessment. Basically, satisfy yourself that the broker you select can render prompt and efficient service and protect your interest. For doing business with the broker, you have to submit a client registration form as well as the member constituent form or a sub-broker client agreement form. The latter contains the terms and conditions relating to order or trade confirmation, brokerage charged by trading member, registered sub-broker and delivery of securities and funds. Now we will discuss about placement of order. After locating a suitable broker, place your order to buy. Your order should clearly specify the name of the company and the type of securities, equity shares, preference shares, or debentures. Note that all transactions through a stock exchange are now settled through the repositories. So you must have a demat account with an authorized depository before you place an order. You can place a limit order or a market order. A limit order specifies the quantity to be traded, the highest price that is the limit price that the buyer is willing to accept and the length of the time the order is valid. A day order remains a day order remains valid only sorry for that. A day order remains valid only for a day when it is placed. If the order is not executed on that day, it is automatically lapses. A week order is one which is valid for 1 week. A month order is an order which is valid for 1 month. A open order remains valid in effect until it is executed or cancelled. For example, you may submit a limit order to buy 100 shares of Reliance Industries until the close of the trading on a particular day at a price less than or equal to the limit price of the 2500. When you submit a limit order, you run the risk of delayed execution as well as the risk that the order will not be executed. Those who place active limit orders essentially stands ready to trade at the discretion of the other market participants. Hence, they supply liquidity to the market, just as the market maker, who is ready to buy when the investors wants to sell and sell when investors wants to buy. When you submit a market order, you merely specify the quantity that you want to buy at the best available price. For example, you may submit a market order for 100 shares of Reliance Industries. A market order guarantees execution, however, the trade price is not known beforehand. Those who place market orders essentially requires liquidity from the market. Put differently, they demand liquidity from the market. Now we will see about execution of order. Execution of order in procedures for buying shares. On receiving your orders, the broker will feed the same on his terminal. Once the order is executed, the broker will inform you and send a contract note representing the documentary evidence of the transaction. The contract note contains relevant details of the transaction. Preserve it for tax and other purposes. You are expected to pay for your purchase within a stipulated period specified by the broker. After you have effected the payment, the broker will transfer the shares electronically to your depository participant account. Now we will see about the procedure for selling. Once you have a broker, the steps involved in selling the shares are as follows. First, placement of order and then execution of order. So first we will see about placement of order. You have to place a sale order with your broker. You may place a limit order wherein you specify the minimum price acceptable to you, or you may place a market order, which means that you instruct your broker to sell at the best available price. Before placing the order, make sure that the shares you want to sell are to your credit in your depository account. Now we will see about execution of order. On receiving a sale order, your broker will feed the same in his terminal. Once the order is executed, the broker will inform you and send you a contract note, that is the documentary evidence of this transaction. You will have to issue a depository participants check for the shares that you have sold in favor of the broker. This check transfers the shares from your depository account to the broker's depository account, just the way a bank check transfers money from the payer's account to the pay's account. You will receive payment from the broker in few days. Now we will see about internet trading. In February 2000, witnessed a introduction of stock trading on the internet in India. Currently, ICICI Web Trade, Sharekhan, Kotak Street, Geojit Securities, InvestMart, and others offers internet trading. To do internet trading, you have to register yourself as a client with the internet broker. Apart from having a computer, a modem, and a telephone connection, you also have to keep a minimum deposit in the bank account with the internet broker. With the bro- internet broker, which the broker can directly debit or credit. For example, for ICICI WebTrade, you should open a bank account as well as a demat account with the ICICI Bank. You can fill the NSE terminal and BSE terminal on your computer screen, and you can key your buy and sell orders directly within the limits assigned by your internet broker. Your orders will get lodged directly on the trading platform. The link in 3-in-1 accounts, savings account, bank account, depository account, and trading account permits 24 by 7 investing security, instant order confirmation, easy transfer of funds and securities, and transparency. In addition, the 3-in-1 account service providers offers fundamental and technical information and market updates free of cost. Now we will see some important points to remember. When you buy or sell shares. When you buy or sell shares or debentures of a company, bear in mind the following points. As per the amended guidelines for listing, a company is supposed to close its transfer books only once in a year at the time of annual general meeting, and to have record dates for other purposes like bonus issue, rights issue, etc. Have uniform dates of books closing and a record date either on 1st or 6th of any month, and to give to the exchange notice in advance of at least 42 days of 42 days or of as many days as the exchange may from time to time reasonably prescribe. Except registration for Accepts registration for transfer that are lodged with the company up to the date of closure to the transfer books, or when the transfer books are not closed up to the record date. and therefore until the transfer books have reopened, registration of any transfers which may be received after the closure of the transfer books and issue letters of allotment or letters of rights within 6 weeks of the record date or date of reopening of the transfer books. After the closure of the purpose of making a bonus or rights issue. On the stock market, the shares becomes ex-dividend or ex-bonus or ex-rights as the case may be several days before the book closure date, that is the record date. The cutoff date for ex-dividend transaction is normally fixed by the stock exchange authorities. For example, in a certain case, the share may become ex-dividend on say August 10. This is indicated by abbreviation XD affixed after the price of the share. Similarly, XB stands for X bonus, CB stands for cum bonus or XR stands for X rights and CR for cum rights. If you buy the shares XD or XB or XR, you are not entitled to dividend or bonus shares or rights, respectively, for which the books are about to be closed. Before going further, uh, while some of in the important points, first we will see architectural deficiencies. The Indian market is more volatile than the US market because of the following architectural deficiencies. Dominance of single stock futures. A major architectural defect of the Indian stock market is the dominance of single stock futures. Trading volumes in such futures is greatly than twice that of cash segment. Curiously, Dr. R.H. Patil, who is the former managing director of NSE, where single stock futures were introduced during his tenure, is now a severe critic of this system. In an article that appeared in the Economic and Political Weekly, he states that all the major futures exchange of the world in the US or Europe consider that the individual stock futures are not only highly unsafe but also they do not serve any justifiable purpose. Despite the obvious risk that the individual stock futures pose to the safety and integrity of the capital markets of the country, they now have been introduced in the hurry in our country. Now we will see about some unrestricted day trading. Day traders in India are not required to take and give delivery. In the US, for example, a person who buys and sells on the same day is first required to pay for the shares before he can sell them. Unrestricted day trading undoubtedly has contributed to speculative excess and high volatility. Now we will see about absence of market making. Market makers which is called specialist in the US, stands ready to buy and sell on their account. They contribute to the orderly price behavior and ensure liquidity even for mid cap and small cap shares. Absence of market making in India contributes to volatility to some extent. Let's come back again to the important points. If you buy the shares CD, that is cum dividend, or CB or CR, as the case may be, you are entitled to the dividend or bonus shares or rights respectively, for which the books are about to be closed. You can obtain information about book closure dates from your broker or from the stock exchange. Financial news like the Economic Times and the Financial Express and the investment magazines like Capital Markets and the Wall Street Journal also provide this information. Now we will see about buying on margin and short sale. First we will see about buying on margin. What does margin means? we will see in this video. You can buy shares on margin. This means that you can provide a portion of the purchase value as margin and the rest is given by the broker as a loan to you. For example, if you have a margin account with kotaksecurities.com, you can get a loan up to 75% of the purchase value. So if your margin account has a balance of rupees 25,000, you can buy shares up to rupees 1 lakh. The percentage margin is equal to the equity in the account or market value of shares. Suppose you pay a margin of rupees 10,000 and purchase the shares of rupees 25,000, borrowing rupees 15,000 from the broker. The initial purchase percentage margin is now first the formula for the initial percentage margin is equity in the account upon value of shares. So let us substitute the formula that comes to rupees 10,000 upon rupees 25,000, which will come to 40%. So the initial purchase margin is 40%. A rise in the value of the shares augments your equity in the account and a fall in value of shares diminishes your equity in the account. Suppose the value of shares falls to rupees 20,000, your equity in the account becomes 5,000 and the percentage margin becomes rupees 5,000 upon 20,000, which will come to 25,000. So we will also substitute that this case into this formula. 5,000, which is equity, remaining equity in the account, and rupees 20,000, that is the value of the shares. If the value of the shares falls below rupees 15,000, your equity in the account would turn negative. To guard against such a thing, the broker prescribes a maintenance margin. Should the percentage margins fall below the maintenance margin, the broker will issue a margin call asking you to infuse more cash in the margin account. And if you fail to do so, the broker is entitled to sell securities from the account to collect enough of the loan so that the percentage margin is restored to an acceptable level. When you buy on margin, your upside potential as well as downside risk are magnified. To see how, suppose you deposit rupees 10,000 in a margin account and buy shares worth rupees 40,000, borrowing rupees 30,000 from the broker. If the shares appreciate by rupees share appreciate by 25% to rupees 50,000, you earn a 100% return, which will come to rupees 1000, that is equity in the account, and rupees 10,000. Rupees 10,000, which is equity in account, and the value of shares, which is also rupees 10,000. Ignoring the cost of borrowing, if the shares falls by 25% to rupees 30,000, you lose 100% and not counting the borrowing cost. Now we will discuss about short sale. A short sale is a sale of shares that one does not have. A short seller expects the price of the shares to fall in future so that he can square his position at a profit. Of course, the price can rise, inflicting a loss on the short seller. A short sale is arranged by the broker who borrows the shares from another customer or broker so that the short seller can effect delivery. The short seller has to buy the shares in the future to replace the borrowed shares and also repay any dividend that may have been paid on the shares. Thus, the cash flows associated with the short sale of the shares uh, are as follows. Since the shorts, since a shorts, since a short sale entails risk, the borrowers instead insist on margin which may be 25% to 50%. Suppose you want to make a short sale of rupees of 10,000 shares. Sorry, short sale of 1,000 shares of Alpha company at rupees 100 and your broker requires a margin of 40%, you must have a balance of rupees 40,000 in your account with the broker to do the short sale. The margin is meant to protect the broker should you start losing money on your account. Suppose the shares of Alpha fall to rupees 80 in line with your expectation. You buy 1000 shares, square your position and book a profit of rupees 20,000. What happens if the price of Alpha shares rises to 120 contrary to your expectation? In this case, your initial margin or equity position reduces to rupees 40,000 to rupees 20,000. That is, the initial margin was that 40,000 minus 20,000, which will come to 20,000, which will be current margin remaining. The broker would instead on certain minimum maintenance margin. Suppose this is a 25%. This means that your equity position must be at least rupees 20 rupees sorry This means that your equity position must be at least equal to 25% of the current value of the stock which has been sold short. In the present example, it should be rupees 30,000, which is 25% of 1,20,000. Since your equity position is only rupees 20,000, you have to post an additional margin of rupees 10,000. So here we come to our end of the video. So thank you guys for watching this video, and if you enjoyed, please like, share and subscribe to my channel. Thank you.